They were analyzing a special report, Tech Stocks Overbought, why SQQQ could explode soon.
It's a sharp short-term trade thesis, really.
It is. It's arguing for a big move in the 3X inverse ETF SQQQ based on, well, basically a perfect storm of data hitting the markets today.
That's right. The PCE inflation, GDP, jobless claims, the whole package.
And you know, the execution plan here is notably strong. What I immediately liked was the surgical timing. The report sets out specific support levels. It has clear price targets, $76.50 and $82.60, and a very disciplined stop loss at $69.
The structure is there.
The structure is there, and it really frames this pre-Thanksgiving volatility as the critical window for action. It's got that punchiness you want.
I agree completely. For a trade built on, volatility and leverage, clarity is paramount. The entry and exit points are well defined.
Right.
But, and this is a big but, when you lean this heavily on an instrument like SQQQ for such a short-term, catalyst-driven trade, the mechanical risks, they just can't be secondary. And that brings us to, I think, the first and maybe the most critical area for improvement.
You're talking about the decay? The volatility decay in SQQQ?
Exactly.
I did notice the report mentions a scenario called the chop, where it says decay eats value in a sideways market. But it almost feels like a footnote.
It is a footnote, and that's the problem. The discussion of this high-leverage instrument, SQQQ, needs a much more explicit and quantified acknowledgement of its structural risk, specifically the impact of volatility decay.
Okay.
Right now, that inherent structural drag is, like you said, an afterthought. It needs to be a critical component of the risk assessment, the very thing that justifies the timing of the entry.
So let me push back on that for a second. If the whole thesis is that the market's about to make an explosive move today, before decay really has time to set in, why do we need to quantify it so aggressively?
That is a great question.
Doesn't the whole idea of a high-conviction catalyst trade imply that the time horizon is just too short for daily decay to matter?
That's the assumption the author is making, but it's an assumption that has to be backed by numbers. The weakness is that the reader needs to understand exactly how fast that decay erodes value if the explosive move doesn't materialize immediately.
Or if it just chops around for a day or two.
Precisely. If they're even one day early on this trade, that structural bleed can seriously compromise the profit potential.
Right. Okay. So the suggestion is to rebalance the risk assessment. We need to integrate the inherent cost, the decay, directly into the reason for entering the trade now.
Yes. Make it clearer that the report relies on an immediate, sharp move.
And support that with some data.
Absolutely. You need to shift this from just being an urgent trade to being a surgically justified trade.
So how do we do that? Give me some concrete examples.
Okay. First, a sensitivity analysis. Just a quick calculation showing the expected daily cost of decay if SQQQ trades flat between, say, $71 and $73.
You don't need a whole model or anything.
No, nothing complex. A simple statement. Something like, given current volatility, a range-bound day costs the position approximately 0.4% of its value due to compounding. That's it.
That's powerful. Quantifying the cost like that validates the tight stop loss, and it really underscores that need for urgency. It turns decay from this abstract concept into a hard number on the P&L.
Exactly. And then you build on that. Explicitly state the break-even time horizon.
How long you can hold before decay eats your potential profit?
Right. How quickly must the market move to that first target of $76.50 to just negate the time decay? If the expected decay is, say, 1.5% over 3 days, the move has to happen fast enough to cover that cost and still generate a profit.
It frames the trade as a race against the clock.
A race against the calendar. It reinforces the decision to execute right now ahead of the catalyst.
And how does the support zone, that $71.30 to $71.80 area, tie into this?
You use that tight support zone to justify taking on the decay risk in the first place. You can say that because the stop at $69 is relatively close, the decay risk is acceptable only because this window for a big move is open for the next 48 hours.
So it's a surgical strike. It's not a medium-term hold where decay would be, lethal.
Precisely. That sharpens the mechanics of the entire trade. Okay, so now that we've handled the instrument itself, let's pivot to the core market narrative.
Right. The report identifies two bearish drivers: First, the macro shock from a hot PCE number.
Rising yields, tech stocks down, the usual.
And second, this very specific micro-level fracturing in the semiconductor space. It cites weakness in NVIDIA and AMD because of shifting AI chip alliances.
And that's where I see a challenge. I see two sources of pressure, but they feel like two different trade ideas that have been sort of taped together.
The report makes a strong case for macro pressure, and it makes a good case for a microfracture. But the connection, the causal link between rising rates and this specific competitive weakness in chips, it's not fully established.
I was struggling with that too. I mean, how do you connect a general hot inflation number to investors dumping NVIDIA specifically because Meta might be looking at Google's chips? That feels like a leap.
It is a leap. The report needs to show how these two stressors interact to justify that big prediction, that 6 to 9% index correction. So the weakness is the analytical separation.
It is. We need to build a clearer, integrated framework, one that treats the macro risk, the rates and inflation, as an accelerator for the micro pressure from chip competition. That's how you show why the Nasdaq is uniquely vulnerable right now.
So it's about explaining why higher inflation doesn't just hurt the whole Nasdaq, but why it specifically targets these weak spots in NVIDIA and AMD that the author already found.
Exactly. Let's quantify it. Let's talk about the forward valuation multiples of NVIDIA and AMD. You can contrast them with slower growth sectors to make the point.
Show how dependent they are on low discount rates?
Yes. If the cost of money goes up because PCE comes in hot, say above 2.7%, their future earnings get discounted way more aggressively. These are the highest multiple, highest growth stocks in the index.
They get hammered first.
First and hardest. It disproportionately accelerates the whole index drop.
Okay, that explains the mechanism. The inflation news is the match, and the high multiples are the dry tinder.
In the micro weakness, the chip alliance news, that's the fuel that's already leaking onto the tinder. You need to illustrate how institutional profit-taking, which is already happening because of this competitive doubt, becomes an accelerated flight from risk when rates start to rise.
So investors who were already hedging their NVIDIA exposure suddenly decide to just liquidate the position entirely.
Yes, they target these specific stocks because they are the weakest and most expensive at the margin. It all connects.
This is really about unifying the entire narrative. And the final piece of evidence is already in the report. That weakness we saw in those stocks on November 25th?
Make that explicit. State clearly that the weakness observed yesterday in NVDA and AMD is direct, real-time evidence that the market structure is already brittle. It's highly susceptible to the shock of the PCE data drop at 8:30 a.m.
That integration moves the report from just a list of bearish factors to a cohesive market call. It makes sense.
It's a singular, self-reinforcing thesis.
Okay, that's a big improvement. Now, let's talk about the other side of the trade. The counter scenarios. The main bullish SQQQ case, the explosion, is defined very tightly by a data trigger, PCE greater than 2.8%.
It is. But the overall thesis would be so much stronger, it would appear so much more robust if it gave equal weight and precision to the main counter-argument.
The melt-up scenario.
The melt-up. A high-conviction report has to prove it's done its homework on why it might be wrong.
And the weakness right now is that the bearish SQQQ counter scenario, the melt-up, is just, it's vague. It says, inflation cools significantly, Goldilocks economy confirmed, and that leads to a drop below $70.
Right.
That vagueness doesn't really help a reader set parameters for when to get out before they hit that hard $69 stop loss. They need proactive signals.
That's it exactly. We need to detail the specific technical and data-driven thresholds that would trigger that melt-up, and we need to do it with the same specificity used for the explosion.
If you're confident enough to name the bearish trigger, you have to name the bullish one too.
You have to. It transforms the report from a directional bet into a balanced analysis of the market structure.
So how do we assign a concrete Goldilocks trigger?
We need a number, a specific number. Define what cool PCE means. For example, say that PCE coming in under 2.5% would instantly confirm a December rate cut.
And would require an immediate exit from the position.
Immediately, regardless of where the price is trading relative to the stop. If the data comes in below that threshold, the thesis is fundamentally broken. You close the position on the news. You don't wait.
That's a really important distinction, the difference between a thesis being invalidated and just hitting a mechanical stop loss.
It is. And we also need to look for technical confirmations that might happen before the stop gets hit. That 69 stop is a safety net. But what are the warning signs?
You're saying track the inverse, the NASDAQ 100 itself?
Yes, identify the technical events.
If the NASDAQ 100 decisively breaks through a key resistance level, like the high from November 25th on that good inflation news, that's a signal. That's a structural shift in momentum, and it requires a preemptive exit.
We also have to think about the market conditions here. It's low holiday liquidity right before Thanksgiving. If we get a Goldilocks number, the market's reaction could be
magnified.
That is an excellent point, and it's a great point for analysis. Analyze the role of that low liquidity in the melt-up scenario.
Yeah.
If institutional desks are running on skeleton crews, could cool inflation data cause a sudden, exaggerated short squeeze? The opposite of the explosion?
The market could just rip higher, and SQQQ could crash through that stop loss in a flash move. It could. And explicitly addressing that risk validates the need for a rigorous, data-driven exit strategy, like the immediate data trigger we just talked about. It adds a layer of depth to the risk management that a reader will immediately value.
This has been a tremendously productive critique. The original report, it excelled at identifying the catalyst and setting risk parameters, but the internal structure, the supporting arguments, they really needed hardening.
Well, our goal was to maximize the reader's confidence in the execution, to provide high-level, actionable improvements across the three biggest areas.
Okay, so let's recap. First, the author most explicitly model the volatility decay risk that comes with the 3x leveraged ETF. Make the need for an immediate directional move mathematically clear.
Use sensitivity analysis. Use time horizons. Take the risk management from qualitative to quantitative.
Second, create a far more robust causal connection between the macro data, the PCE inflation, and the specific weakness in semiconductor stocks like NVIDIA and AMD.
Show exactly how the macro risk acts as an accelerator for that sector-specific fracture.
And finally, detailing the precise data and technical triggers for the primary counter-thesis, the melt-up, makes the whole analysis more balanced.
And it gives the reader superior proactive exit strategies, ones that prioritize the thesis being invalidated over just hitting a price stop.
Implement those 3 strategic adjustments, and this special report will go from being a high-conviction call to a highly sophisticated, fully vetted, executable strategy.
I think that's exactly right.
We look forward to seeing the revised version. Send it back to us, and we'll be here next time to help you build your best work.